Good afternoon, everyone. It's my pleasure to welcome you here to the November seminar. My name is Audra Kruger, and I work here at the Center for the Study of Cooperatives. And I'd like to welcome those in the room, but also we are live streaming today, so there are people viewing from the comforts of their home or more likely their offices, so welcome to them as well. And just so folks know, we're also recording this, so it'll be available on our YouTube channel and our website in a couple of weeks. It's my pleasure to introduce our speaker today. We have Brent Hueth here, and he is the faculty director at the University of Wisconsin Center for the Study of Cooperatives. I'll let our new guest settle. There's lots of chairs up here. Welcome. Front and center, no back of the class, seating allowed. They're very comfortable chairs. And feel free to grab some food too if you like. I'm just introducing our speaker and welcoming those viewing online. Brent is also an associate professor at the Department of Agriculture and Applied Economics at the University of Wisconsin-Madison. And I should also say that he's an old friend of the center. Maybe not old, because he's not that chronologically old, but he's a longtime friend. We like to think of his center as sort of our American cousin. They do similar work, so we work together a lot and collaborate quite well together. And he is also, we are also the beneficiary of his wise counsel, as he is on our advisory board as well. So he is able to participate in a high level on the direction and mission and vision of the center. Brent earned his PhD in agricultural economics from the University of Maryland. He spent 2 years as a postdoc at the University of California, Berkeley. After a stint at Iowa University, he spent a year, probably it was too short of time, at Toulouse, France. His research and teaching focus is agricultural markets, cooperatives, cooperative enterprises, and economic development. Please join me in welcoming Brent. Thank you.
Thanks very much, Audra, and it's really a pleasure to be here and have an opportunity to present. I don't think I've given a seminar here. I've been here a couple times as an advisory member for the center here, and like Audra said, it is we view it, I've always said sister, but I guess cousin works too. I just envision it as being a little closer. And so I'm really grateful for the opportunity to talk, and look forward to getting reactions from people. This is a topic actually. I've been involved in co-ops. I got involved in them initially as an agricultural economist working on agricultural markets, and you sort of can't avoid co-ops if that's what you do for a living. So eventually I ran into them, but I've been heavily involved for the last, I'm going on 9 years now as the director of the Center for Cooperatives at the University of Wisconsin. So it wasn't long after I arrived in Wisconsin that I started thinking about this topic. And this is the first time I've presented on it. So it's something I've been mulling over for a long time and been trying to sort out, and I've been very quiet about it actually, because it's an important topic for folks in the cooperative community. And I didn't want to misstep too awfully. I do that enough already in various minor or major ways, and this seemed like a place where I didn't want to take too big of a misstep before I felt like I understood what's going on. And I feel like I do understand something now, at least enough to feel pretty good about talking about it, and I think it's really interesting. So hopefully you folks will see some merit in what I'm saying, and if you don't, I'd love to hear about it and discuss it. So I want to start actually by reading. It's kind of a lengthy quote, so bear with me. But I think it's a fun quote, and especially for those of you who, I'm sure there's there's lots of levels of knowledge of co-ops in here, so I'm going to be try to be pretty general in terms of how I talk about things. But I'm sure I know there are some of you here who have thought about this topic for a while, and so you will appreciate this more than others perhaps. But I think it's interesting. Will be interesting to everybody. So here's a quote. So it comes from this paper. So it's the 1955 paper, and Charles Nyman was a lawyer for cooperatives in Minnesota. So the quote is, this quote is actually typical for a law journal article. This is the first sentence in the second paragraph, and it's footnote 5. And it's a long footnote. So it says, and it's a footnote on a sentence that says, the cooperative's income tax cases constituted a long course of administrative and judicial wallowing among various theories. So this is all about tax law in the United States. So it says, let us first, for the moment, and with appropriate sympathy for them, consider the mental tortures which the judges underwent when they first sought to analyze the cooperative corporation. At first blush, no particular problem was apparent. It was assumed that cooperatives were corporations, just like any other incorporated business unit was a corporation. Ergo, by applying the law applicable to ordinary corporations, there should be no particular problem. But it was not long before the fallacy of this proposition began, and I say advisedly to become apparent, although the fallacy is still deeply rooted and widespread among uninformed businessmen and lawyers. The more closely the cooperative corporations were scrutinized through the judicial microscope, an unbelievable and almost horrifying fact began to draw upon the judges. These cooperatives were neither fish, fowl, nor flesh, yet they possessed some of the attributes of all three. In applying the law of the general corporations to cooperative corporations, the judiciary did not fare badly until they were confronted with the lethal patronage refund. This was a new one. There was nothing in the books on the subject. Yet since the cooperative was a corporation, there just had to be some bolt in the corporate anatomy, since it is an inanimate entity upon which this nut was to be screwed. As a flash from the blue, finally came the answer to a perspiring and exhausted judiciary. Why, it is merely a corporate dividend. Why in the name of heaven didn't we recognize this sooner? This opiate was short-lived. Corporate dividends were predicated upon investment by stockholders. These so-called patronage dividends had no apparent relation to investment, but were anchored to something entirely new. Volume of business done with the corporation, in other words, patronage. Then followed the second anguished effort to classify this elusive patronage refund in normal and accepted corporate terminology. Again came the flash from the blue. These things are nothing more nor less than trade discounts. Why didn't we think of that sooner? But the bliss did not last long, and the second opiate again wore off. Trade discounts as to the purchasing cooperatives were fine, but the corporation had taken on more from the patron than that which it had sold him was worth. But what about the progressive payments to farmers for products which he sells through the association? And here again the fog closed in. Of only one thing may be sure out of all the welter of the present confusion on this subject, namely that the status of patronage refunds is governed by the law of contract and contract alone, except as a positive statute law may control a cooperative business unit. As in the case of all contracts, the legal relationship created thereby depend upon the terms and provisions of the contract. Hence, abstract generalization on the subject is very difficult, if not impossible, and this may be, and probably is, the chief reason for the present state of confusion. So, this is 1955. There's a lot of anguish about defining what a patronage refund is, and essentially what earnings are in a cooperative, and how to think about them, and what to do them, and how to treat them for tax purposes. And the problem I encountered when I started in the Center for Co-ops was that this confusion was apparent to me immediately, today, or at the time I started, among cooperative practitioners and lawyers and economists and pretty much everyone I encountered. I couldn't get a straight story about what the issues were here, and I really had a hard time coming to understand what people were dealing with. So I think I've come to think that it's not entirely a semantic issue, but there is an important semantic element to this, and I don't know what it is, but something happened in 1950 or 60. I don't know. We can't write anymore. I don't know. Like when I go back and read stuff from 50 years ago, like people actually wrote, and so this is from, just nothing special about this report, but it's the report on the classification and terminology used by business lawyers. This is a committee of an association of the American Bar Association submitting its report, and they take the time to say in their opening of the report, words are the vehicles by which ideas are conveyed. Words are merely the audible or visible skins of human thought. How often do you see that in a committee report today? So it's true, though. And the cooperative corporation, the thing that they were dealing about was terminology and words used to describe finance in cooperatives that were borrowed from corporation law and private corporation law. And that these terms that were being used were creating a lot of confusion. And the whole point of this committee was to try to define the terms and come to an understanding of really what it was that is different, or what it was at the time is different. What it is today, we're still trying to figure out what's different about basically cooperative capital. What is cooperative capital? So this is one of the places where I've been trying to sort things out is in a little research group that is sponsored by USDA in the United States. Every year we get together as mostly ag economists and talk about our research. And I've had an ongoing dispute with other fellow PhD economists about what we should call retained earnings. There are a lot of economists today and a lot of lawyers, and you'll see it used sort of informally and casually. Retained earnings will be referred to as an investment by members in their cooperative. And you can see in this is back sort of before, so the previous article is 1955. This is 1945. And you can see even here the confusion. So this is an interesting paper about sort of the public policy rationale for cooperatives, and it says a cooperative is operated for the mutual benefit of its members. Advantages accrue to a member in relation to patronage, not financial investment. And then the next little ways down, the same paper, and he doesn't realize he's doing this in the paper because it's just a casual use of the term, but he says the only methods by which farmer cooperatives may obtain capital are borrowing an investment by retained earnings by farmer members. So he's sort of lapsing into a really convenient usage of the term investment, but investment has a real economic and financial connotation, right? In particular, we're taught to measure the value of investment through return on investment. And we'll see, and I'll show you examples today where there's a lot of confusion and unwarranted conclusions drawn from trying to apply this principle to the earnings of cooperatives. Okay, so and I think some of it stems from people just trying to think of this of these retained earnings actually is an investment that generate cash flows. So. That's just a little motivation, early motivation, so that the rest of the talk I'll kind of provide some more motivation. I'll point out what I think is a puzzle that we kind of have to come to grips with if we're going to understand what this cooperative capital is and what it's doing. For those of you who are not corporate finance professionals, a short little moment on what cost of capital is and why it's important to think about. And then I'll provide what I think is kind of a resolution of this paradox from my perspective. And then they'll point out some what I think are really interesting policy implications if we all agree to understand it this way, and then some future directions. Okay, so the motivation is that, and I'll just show you some evidence here in a second. If we don't know how to value a cooperative, that's a dangerous situation to be in, because cooperatives do receive public policy, special treatment from public policy. They are under attack in some sex quarters by competing businesses, and in order to be able to defend themselves both in the political and economic sphere, and also, perhaps most importantly, to be able to communicate to their owners and members why they're valuable, they need to be able to measure that value and communicate it effectively. So here's why it's dangerous. Here's some examples. So this is a report. This was actually, I wasn't around. I don't know that I would have been able to do anything at the time it was presented, but it was presented at a conference that my center organizes, the annual Farmer Cooperatives Conference, which I'm heading to this afternoon. It'll be Thursday and Friday this week in Minneapolis. But this was in 2002. And somebody from McKinsey stood up and presented these results at the conference. And the results were from a study that was commissioned. I don't know by who actually it was commissioned by, but the conclusion of the study was that despite the 1.5 trillion a year that agriculture and the activities associated with it bring to the U.S. economy, much of the industry is destroying value. The problem is one of the industry's traditional business models, co-ops, with few notable exceptions, they destroy value. Yeah. So I don't know what. Apparently, there was a bit of a sort of pause, when this was presented within the audience, but people didn't. There was no response. There was no real coherent response to this, other than to say, maybe that's not right or something. So they had some nice pictures too. Here they call it the value blight, sort of, kind of an agricultural-based metaphor. What's that? Okay. Yeah, so cooperative just destroying value throughout the economy. Okay, so now here is more recently. This is Representative Jim Cooper from. He's a senator in the United States. He's a Democrat, actually, but he's become very angry with rural electric utilities. And the reason he's become angry is because he doesn't understand their equity structure. He sees on their books lots of capital, member capital, and his view is that more of it should be returned to members as dividends. That it's basically payment that these members have accumulated capital credits in their businesses, and that those capital credits are due members, and that the co-ops are not doing a good enough job of returning that value back to their communities. So that's an argument or a discussion that can be had. What's the appropriate level of refund and versus investment with earnings? But the way he presents the article, and it's in the Harvard Law Journal, and it's by a U.S. senator, is misleading and demonstrates a real misunderstanding about what cooperative capital is. And part of the issue is that he's expecting and thinking of this capital as an investment that demands a return in cash flow. Here's another example. So this is a new law in the United States, which it used to be the case that when two co-ops merge, they could just pool their assets and become a single entity. And now, as of, I'm not sure what year it was, but it's ASC 805. It wasn't that long ago. It was in the 2000s sometimes. Cooperatives actually have to determine who's an acquirer and who's an acquiree, and they have to value the assets of the acquiree. They don't have to pay the price that is demonstrated by the valuation, but they do have to try to value the company. Okay, so here's I'm going to show you some results of a particular report. So the co-ops, whenever they want to merge, they have to have these reports done. They hire consulting companies to do the report. This is just the title from report. This is something. The second figure is totally unrelated. It was basically a hostile bid by investors to buy the assets of a cooperative, and it went to the board of directors. The board of directors had to vote. The investors tried to recruit, members to participate in the vote and to overturn or to influence the board, and it was a costly sort of period for the co-op dealing with this buyout, which again is not necessarily a bad thing. If somebody comes to you wanting to buy your company, that's a nice option to have, and you want to be able to evaluate that option, but you want to be able to evaluate it coherently, right, with a model that makes sense given the business structure that you operate with and given the value of that business structure to your owners. So if you ask this particular accounting company to do a valuation for you, this is what they'll do, or what most of them are doing. It's sort of a standard approach. They'll first do is they'll do a discounted cash flow analysis, and they'll basically look at the net present value of cash flow to owners, and we'll call that the value of the company. And that's a standard way of valuing a public company, is you look at the net present value of future dividends with a terminal expected realization of stock price, and you put those two things together and you have the value of the company. So they're trying to apply that model here, and critically, one of the things that you have to be able to evaluate is the cost of capital. So what's the opportunity cost? One thing is the present value of one thing is the cash flows that you're going to get from the assets that you're financing with your equity. The other thing is what's the opportunity cost of your equity if you used it somewhere else, right? And so we have to know that. So a critical piece of doing evaluation in this context are the cash flows. You have to estimate those, and you also have to know what the cost of capital is. The other approach is just to measure net assets on the balance sheet. It's a market-based approach. So they went with net assets on the balance sheet because this is the result they came up with when they measured cash flows. Customer relationships. At the date of acquisition, acquiree had significant relationships with its patrons. However, the cash flow from the existing customer base is insufficient to cover contributory asset charges, expenses, operating expenses, on tangible and intangible assets, resulting in no value to the customer relationships. The sum of the present value of the excess earnings was calculated to be less than zero. The fair value of the customer relationship as of the valuation date is zero. Now, if you're operating a cooperative, what do you want to achieve? That. That's exactly what you want as a cooperative. Accounting fully for costs, right? You've got to include investment, new investment. You have to have capital for new investment. You have to have capital to cover depreciation. You have to pay competitive salaries. You have to invest in marketing and advertising, customer relations. You have to pay all innovation. You have to do R&D, right? You have to do everything you need to do, and you need all the capital that's required to do that. But at the end of the day, you want to take all that value and give it back to your patrons. And if you do that right, there shouldn't be a whole lot of excess profit in the co-op. And so if you try to measure cash flows, and what are they measuring for cash flows here? Patronage refunds, right? That's the only cash flow. There's no cash flow. There's nothing. The price is irrelevant here. The price the patrons are paying. The only thing that they're measuring is cash flow through patronage refunds and redemption. So those are the two. They're basically computing a net present value of annual cash refunds plus redemption, and calling that the discounted cash flow to owners. And so what they're doing, I think this is the proverbial square peg in the round hole, right? I mean, they're taking a model that's used for, that they're taught in business school and in their profession, and they're applying it to a different model that where it's not appropriate. This is another source of motivation. It's different. It's less tangible and a little bit more conceptual, but. In the U.S., there are several prominent instances now of where there's been major public policy initiatives, sort of systemic intervention. The federal government, think of it as like creating a new farm credit system, or some other sort of large-scale. In our case here, most recently, it was the Obamacare, the Affordable Care Act. And basically a whole new system for health insurance nationwide. And one proposal was to make it a cooperative system, not unlike the farm credit system that we have in the United States now. You have it run through your federal government as a public agency, but it's not unlike the sort of cooperative model that we have that's sponsored as a government-sponsored entity. So it's a hybrid that has a relationship to something that's public. We did this with health insurance, and we did it badly. And the reason we did it badly is because people don't understand co-ops, and there wasn't public policy. There wasn't awareness among policymakers of how to structure a co-op properly. They didn't consult with co-op leaders, and in fact, they called it a co-op in name only because CO-OP, as when you see it in the policy documents, it's always capitalized because it doesn't stand for cooperative. It stands for consumer-oriented and operated plan. So it's an insurance plan oriented and operated by consumers, but it's not part of, it doesn't operate under any existing cooperative statutes, and it wasn't something that they consulted the cooperative community about thoroughly before creating it. And so now we have a situation where there's been several tens of billions of dollars. Actually, I don't know, what is it lost to 1 billion? So a billion, a little over a billion, 2.4, I guess, is so far. But we're down to 11, I guess. Well, 23. No, I think we've 9. So yeah, I think this is fairly recent. I think there are 9 or 10 that are shut down out of 20 some, and it's likely there will be more shutting down. So hopefully some will survive, but they're not actual co-ops. Yeah, they're not investor-owned either. But you know, there wasn't good thought, a lot of good thought put into their design. And then there actually is a proposal in the House right now that was built off of staff paperwork by professional economists at the New York Fed to bring Fannie Mae and Freddie Mac, which you've probably heard reference to, but these are giant vehicles for liquidity in mortgage markets. To bring them out of conservatorship where they are now, which just basically means they've been confiscated by the federal government, bring them out of conservatorship and into a co-op. So that's something that's under, the New York Fed has written 2 very thoughtful technical policy pieces on this. Whether that gains traction in Congress will depend, you know, to some extent it's going to depend on being able to speak intelligently about how this would be structured and why it makes sense. And understanding cooperative capital is an important part of that. And then if you're an economist or interested in economics, there's a bunch of other reasons to find interest in this stuff. You know, we don't really know, we can't really assess the normative impact, sort of the policy value of co-ops very well without understanding what their capital is about, how they operate in markets, normative issues in terms of how you manage capital. And I also think of it as the whole you know, policy relevance of co-ops is sort of being a missing chapter in economics textbooks because they do serve a regulatory and corrective function in markets, and most textbooks just jump from, you know, market frictions or failures to government intervention. And government intervention usually takes, you know, a small number of forms. It's taxes and subsidies and ownership by government or public provision. So I think hybrid ownership or alternative governance, whatever you want to call it, is something that hasn't received enough attention by economists. Okay, so for me, there's a puzzle related to cooperative capital, and this is the key thing that I'm trying to focus on in thinking about this issue, which is cooperatives generally don't pay anything for their equity. Some of you, if you're familiar with co-ops and their financial structure, I've encountered some pushback on this, that maybe this isn't the case. But I think a pretty compelling case can be made that it is the case. So credit unions, for the most part, don't pay a patronage refund. So they have equity on their books. They pay, you know, they provide loans and other financial services to their customers or members, and they accumulate retains, and then they never have to pay anything for those retains. They just hold on to them and use them, and they plow them back into the business, right? But there's nobody receiving a dividend. Farmer cooperatives in electric utilities in the United States, and I don't know exactly what the situation here is, and I would love to learn more about the Canadian context, but generally they use some form of revolving equity. It's referred to as revolving equity, which means you generate the retains that you generate through your patronage each year are basically tagged with your name. And they're tagged in a way that's they refer to it as an allocation. So your earnings are allocated to you based on your patronage, and then that information is tracked over time. And periodically they try to revolve out equity. So usually it's on a first in, first out basis. So the older generations get their equity back, and as new earnings accumulate, it just rolls through, and it's a revolving equity fund in that sense. But if you view the retains, if you actually review the retains as an investment, right, the par value of the retains, so you're a member or patron, and there are $100 allocated to you in a given year, and you treat that and think of that as an investment, literally, then to calculate the return on that investment, you have to think about what your cash flows are, right? And if your cash flow is a redemption 5, 10, 15, or 20 years from now at par, you've earned a negative return, right? Because of basic present value calculation. So negative returns there. If we think of this as an investment, right? So that's part of the issue here. Mutual insurers generally are considered to pay below average on their policies for equity relative to investor-owned insurers, providing the similar kinds of insurance. They don't pay as high a dividend. And in general, there's a sense among practitioners that I interact with that, and in fact, the whole electric utility industry, based on that Cooper article, right, the whole industry is really focused on encouraging co-ops to pay out more. Their equity is too cheap. They need to put a higher value on their equity. There's a lot of educational effort directed at boards to try to educate them about the need to use less debt, or to use more debt and pay out their equity. Okay, so I'm sort of agnostic about whether that's a good policy or not, whether we should be asking them to pay out more or not. But the fact is that some people think that the price that they're assigning to their equity is too low, that they're just holding on to it and using it instead of debt. Okay, because they're viewing it as basically free, right? It's just this capital they generate and has no cost. So where does this take us? What does this mean in terms of, does this mean that co-ops, that their equity is free, that their members don't value this financial capital? Does it mean that where, if you think about it conceptually, like you take two firms, suppose it's an electric utility, you pick any firm and you compare the investor firm with the co-op firm, it is true, right? You think the co-op provides a service, it generates earnings, pays for its debt. The investor-owned firm does exactly the same thing, right? But it has another outflow. It pays dividends too. Right, so if we're looking at two firms, exactly the same prices, exactly the same costs, exactly the same operations, and one also has a dividend flow, that dividend flow is an extra surplus. Right, so where is that in the co-op? How do we understand that difference? Right, we do need to think about that. So here are some possible answers. Members are ignorant and ambivalent. Co-ops are inefficient and wasteful. Co-op leaders earn rents or steal from their members. Or something else is going on. And this is Bob Dylan via Abraham Lincoln. I had to find out when it was actually quoted by, if it was actually Lincoln, and it was Lincoln. He said, you can fool some of the people all the time, and all the people some of the time, but you can't fool all the people all of the time. So this is, economists say this too. We'll give Lincoln credit for teaching us that, or at least instilling us with the belief that people generally are not totally dumb, and like if you see something happening in the world and it's happening over and over and over and pervasively throughout the economy, that there's some logic to it, and that people aren't just being dumb. So, one way to think about this is some of you may have heard reference to the equity premium phenomena. So there's a general sense, at least in the U.S. economy. I don't know what it's like here, but that there is too much that over a long period, right? This goes back to like 19th century. So they've measured from like 1880 to 2010, you know. And in general, the return to equity relative to debt, the cost of debt, is above what can be rationalized by standard economic models. So there's too much premium. Investors demand too much on their equity, or they get too much, or firms pay too much, whatever. There's just too much premium relative to the risks that are there. So you have to, you know, we think of the return to equity as being fundamentally a compensation for risk bearing. And so the more risky the investment, the higher return you have to get. But it seems, at least in U.S. markets, that that premium is too high. So we could think here of there being kind of an analogous equity discount puzzle, which is that you know, co-ops don't pay for their capital essentially because their members are willing to accept a discount, right? So just as investors seem to be demanding too high of a premium and getting too high of a premium, co-op members aren't really demanding from their firms a return on their investment. Again, we have to think of this retained earnings as an investment, but if that's the way we're going to think of it, fine. Then we can just say that members aren't demanding a return, right? So can we account for this in a standard economic model? Of course we can account for this. There's very little we can't account for. But we need to do a little primer on cost of capital first. So the way to think about cost of capital is you borrow from banks, and you basically borrow from investors, and the average cost of that borrowing is your weighted average cost of capital. So weighted average cost of capital, you take your proportional share of equity and multiply it by what your return is, what you have to pay to get that equity, and you take your debt, proportional share of debt of total assets, and you multiply that by your interest cost, and then you add those together, and you have a weighted average cost of capital, which is what you have to pay to finance your assets. So you either finance your assets with the money you get from owners and investors, or you finance them with debt, and capital structure is about managing that balance. What's the right balance? So it turns out actually, measuring the cost of equity. So we know how much debt costs because it's apparent. It's a market measure. It's interest, right? We have to pay for that. It's not clear for a public company how to measure the cost of equity, right? So what is the cost of equity? It's sort of what you have to pay to get people to invest in your business, right? So one way to think about it is, what do you have to pay if you're trying to attract investment funds? You know that in order to get those funds, you're going to have to generate a belief among investors that you're going to pay dividends, or that your stock is going to appreciate, one or the other, right? And the amount that you have to pay is going to be more if they perceive you as being relatively risky, right? So if you're viewed as relatively risky, you're going to have to promise a high dividend, right? Or you're going to be like Amazon, you're not going to ever pay any dividend, and you're going to promise you're going to conquer the world in 20 years, and they're going to be like owners of the universe, with their stock, whatever stock they own. You have to high stock price, right? One or the other, but you have to promise something, and that you have to promise more. You have to promise more when there's more risk, an expectation. So we can think about either calculating, after a few years of data, we can calculate a return on equity for a company. It's just whatever their dividend was divided by what we paid for stock price. It's return on equity. We can also think about what we should pay. How much, given the expected dividend, how much am I willing to pay? right? So when you see there's one way to estimate the cost of capital is to look at your past dividend as a corporation, a public company. Look at your past dividends, and most corporations try to maintain stable dividend stream. Look at your past dividend stream. Look at what the market is currently demanding for a price, what the current price of your stock is, and then that sort of implicitly tells you what people are demanding as a rate of return. Okay, so if the stock price, given your dividend stream, the current stock price is very high, then people aren't demanding much of a return on equity. If the stock price is very low for a given dividend stream, then people are demanding, they have an implicit, they perceive there being more risk. Right? They're demanding a higher return in order to buy your stock. So we can calculate an implicit cost of equity that way for public companies. So business valuation then, if you're going to value a business, what you do is you figure out what the expected dividend is, you figure out what the cost of equity is, and you calculate that cash flow, discounted cash flow. And that's basically what somebody's willing to pay for stock. And then that willingness to pay times the total outstanding equity is the value of the company measured by owner's equity, the value of equity. So what should we do? So now it's quiz time, right? So you've got the concepts down. Now we need to apply them to a totally different context. The cooperative business model. What's different about the cooperative business model? It goes back to the very first quote. So I didn't emphasize it, but the title of that first paper that I put up, and I quoted extensively from, was Multiple Contractual Provisions of Cooperative Bylaws. And it's a fascinating paper. I'd highly recommend it if anybody wants to dig deeper into this. The point of the paper is that if you look at the bylaws of a cooperative, there are at least two and probably three contracts, separate contracts embedded in those bylaws that in comparison with the analogous investor-owned business. So there is the patron contract. What are you going to deliver? How much am I going to pay you? What's the quality of your delivery? Okay. There is the investor contract. How much capital are you going to provide, and how am I going to pay you for that capital? And then there's also a member contract, which is you get to vote, right? And those three things, in principle, could be unbundled. And usually they're unbundled in a pair, right? Which is there's the patron contract, and then there's the member capital provider contract bundled into one, and that contract is called the investor contract. But so in order to think about valuing a co-op and thinking about what the capital is, we have to take account of these two transactions, right? As economists, what we do when we measure patron value by something we call consumer surplus, right? It's how much consumers get net of the price they pay. It's an area under a demand curve above the price line. And we measure investor surplus by discounted cash flow. Well, it's one person getting both flows here. So if we're going to measure the value of a co-op, we have to measure both flows. We can't just look at discounted cash flow. That would miss the other hat that all co-op members wear, which is their patron hat, right? So another way to think about it is that the transaction that co-op members have with their co-op, in it is two flows. Like, we can't really separate them. The co-op could charge a higher price if it's supplying stuff to members and earn more and then distribute a higher cash flow, or it could charge a lower price and distribute nothing. And we can't pick one or the other. It's arbitrary, really. Usually co-ops will benchmark on a market price, right? If there's a well-defined market price, then they don't have to make that decision. And it's nice, it's easy, because they can just charge whatever price is the market price, and that's a good way actually to benchmark managerial performance. If you can't earn a return at the benchmark market price, then that's saying something about how your management is operating relative to the market that's able to deliver at that market price. or to other firms, right? So it's a nice benchmark, but that benchmark isn't always there. Co-ops might be operating in a market where there are no other providers, or they might be operating in a market where they're providing something different, qualitatively different, or maybe with a quality difference. So we have to take account of these two transactions. So now back to the kind of the semantic issue. Do we want to call retained earnings an investment? Well, that multiple provisions paper and then lots of other papers, so these were all written in the 40s, 50s, which was a time in the US when there was massive confusion as a result of decisions IRS had made with regard to taxation of cooperative income. There was a lobby called the Fair Tax, FTL, I think it was the Fair Tax Lobby, or Fair Tax Association. These were investor-owned firms that wanted a fair tax system. They wanted co-ops to be facing the same tax, corporate tax, as they did. And the way they lobbied was to say that these earnings, you know, that co-ops generate are earnings for the retained earnings for the co-op, and they should be taxed as retained earnings. So the lawyers in the United States said, no. Actually, what we're going to do, the way we're going to deal with this, instead of just saying it's a co-op, it's not an investor-owned firm, you know. I mean, the simple man on the street solution is it's a co-op. No, you know, it's doing something different. There's a public policy rationale. There's a reason to treat them differently for tax. It's not the same firm performing the same social function, right? They tried to sort of operate in the sphere of business law and business finance. And so the way they did that was really ingenious, because what they did is they said, let's write a contract in the so it has to be there's have to be a pre-obligation. Okay, so it could be in a membership contract, but it can also be in the bylaws. And what the contract says is literally in the courts. So this has been adjudicated, and this was won and undisputedly true in the courts when it was brought to the courts as a valid contractual instrument. And the instrument is in the bylaws or in the membership agreement. The co-op is obligated to allocate earnings to members. So it's never the co-op's legally. They can hold on to it as long as they want. It's at the discretion of the board, but it's not theirs. But they are obligated to allocate it to members, so it is never in the co-op's hands. But then that wouldn't work very well for purpose of capitalization of a business if members could claim their earnings immediately. So there's another contractual provision, which is that the members are in turn obligated to reinvest those allocations back in the co-op. So there's a two-way obligation, and it's a mental legal fiction physically. It doesn't happen physically, but it's a legal arrangement where effectively the co-op never has any earnings. And only one person pays tax, it's the member. So there's not double taxation of both the member and the co-op capital. So another way to think about it is that the co-op, the capital, that retained earnings, they are never profit. They're investment capital. So it's like you go out each period and you get new equity. When you get equity from investors, it's not taxed, right? It's equity, it's not profit. You're asking for somebody to give you money and you got to promise a return, right? And that's fine, except co-ops don't provide a return. So it's not quite investor capital. So should we call it an investment? Well, if we're going to call it an investment, we have to know. We have to think there's a return. And so my response is no. We shouldn't call it an investment. We should call it something else. We have other words. There's all kinds of, I think these fancy terms like mezzanine, preferred stock, subordinated debt, whatever. I don't know what these things mean. I know they all mean something like, you're more or less likely to get your money back if the company goes broke. And we should just have another term here called cooperative capital. It's different. It's just something else, It's money that where there's not much of an expectation for return because nobody's taken money out of their pocket to invest it, except for the original. So I do think it's really important to make a distinction between original capital and interim capital. So one thing is the original founders who took money out of their pocket, and I think if you go back and look, it'd be an interesting case and analysis to do if there were data, but my guess is that in most cases when co-ops are formed, they pay their original capital a return if they're successful, right? People get compensated for the extra work or the risk taking. But sometimes I have seen it explicit where there are different stock issues or different rights to earnings based on when you came into the co-op, right? In particular for founders. And then also within the interim capital, there's another whole separate interesting issue, which is the generational aspect and how you decide to return. If you do have refunds or dividends or patronage, or redemption or whatever, it's a sort of arbitrary decision about who you give it to. The revolving fund precedences puts in priority, the earlier generations, and then later generations get less. But the way that that's hammered out in the board is that oftentimes, at least in many U.S. co-ops where they use redemptions, the board will demand a cash payment in the current year. So that's reflecting current generation interests. So who you decide to give the surplus to in any kind of distribution of savings is a potentially a contentious issue. And there's a whole another realm of thinking about, what's the right way to do that and what are the trade-offs associated with different distribution plans or mechanisms. But we could look at those cash flows. We could also look at the as a way of valuation. But we need to measure both, right? We need to measure the consumer surplus and the finance or the cash flows, and we need to distinguish original versus interim. We could also just look at aggregate return to equity. How much, if you are making financial distributions, what's the aggregate rate of return that you're offering in cash as a base on your total equity? And that's more of a sort of an average return to everybody. And generally that's very low for co-ops. If you look at that, it's much lower than market rates of return on equity being distributed. So this is separate from what's happening internal, right? One thing is earnings, return on equity inside the firm. Another is actually how much you're return to investors, cash going out the door. And then the last point, which I haven't touched on at all here yet, but is really important, which is that the return doesn't just accrue to members. Most co-ops, if we think about why co-ops exist, it has to do with some kind of market friction where private investor-owned firms were failing in some way. They weren't satisfying the conditions that we think of as being sort of optimal for market performance, and in particular somebody or some group of individuals within the community or the market were dissatisfied with what they were receiving, right? They felt like they were abusive prices, poor quality, no market at all, something, right, that was going on where markets weren't working. We don't form co-ops to produce shoelaces. Stuff that we can get, that's easy to get in the market, we just buy it. It's a lot easier. Nobody wants to form a co-op necessarily, except when it's really important, right? Because what we need, we can't get, or what we can get isn't what we want. So usually, when we do that as a co-op, there are spillover benefits, either on the community or most prominently in my case, in the cases I know of, on the market, right? So if we're talking about agriculture, it's competition, credit markets, competition, promoting competition. And it's not a measure that can be easily observed, right? You can't, because there's always going to be an equilibrium price, there's going to be a general market condition. Over time, co-ops are just going to become embedded in those markets. And even if they're having a positive impact on market performance, there's no place to measure it directly. But it's a critical component of value that the co-op provides. And so I say that there's no place to measure it directly, but there are ways we can measure it. Okay. Just really briefly, there's also some cost considerations, which co-ops. There are reasons to think that co-ops might be more costly, right? So even though they have these other benefits, spillover benefits, there are some countervailing costs potentially. They can't as easily source equity. Maybe that means they have a higher cost of debt. Maybe they're cumbersome operationally because of their governance structure. So kind of a policy consideration is, will cooperatives emerge when that net is positive? And I think in general, our first take on this as economists, we'd say no, because there's a collective action problem. You can't capture all the benefits in a small number of individuals. So even if the net benefits are positive, there's an organizational and collective action cost that's going to restrict startup. And it's very analogous to what we sometimes refer to as public goods problem, where goods don't get provided in the market because there are big spillover benefits, and it's hard to get people to come together when they can't benefit individually. So the same thing will happen here in principle, in theory, in concept with regard to co-ops. So it's a potential role for policy intervention. Okay, so I think this kind of thinking about co-op capital this way has lots of different implications in terms of public policy, in terms of how we think about valuation and capital management. It also has implications for just basic economics, understanding of markets. I think for me, it opens up ways to think about how to do research and education on co-ops that are different than what I've seen in the past. So I'm hopeful it can lead to new work. And I want to emphasize that I'm just stating most of what I've said already, but the big point here I want to emphasize is that this stuff can be measured. I mean, economists try to measure lots of different things that seem like they'd be hard to measure, but we're usually pretty creative and can get some sense of what some of these values might be, and that a big thing that we need to do collectively within the academic and co-op community is figure out how to do that. So thank you very much for your patience and listening to me, and I'd be really happy to take questions if there are any.
Do you have any questions?
Back there.
Who's got their hand up? Oh, I'm going to give you the mic for the benefit of the recording.
No.
This is brilliant. Thank you. I really enjoyed it. It's also interesting that you're going into discursive sociology in terms of ideas and the way that words are used in some of the stuff in economics.
Is that what you call it?
Yeah,
good,
that's
good,
what
good,
I would call it. So the one thing I wanted to ask is, you did talk about the three transactions that the co-op members have, and you talked about the one as the member. Mm-hmm. Is there a way, or is this one of those opaque things that we can't measure, but is there a way that you've thought about how we can actually quantify the value of that in any way? Or is it one of these things that is difficult, like in terms of being able to vote and have that?
Yeah. I guess the way, at first blush, the way I would be thinking of that is in terms of, it's always benefit and costs thing. So like membership carries costs too, but the benefit would be the direction that the firm would take. It's really sort of the strategic direction the firm would take that would be different relative to not being able to exercise their voice and governance. So how you'd quantify that, you could quantify it not necessarily in terms of financial or welfare benefits to economic participants in the market, but in terms of, quantitatively in terms of the different structures and different directions that co-ops take strategically, right? So they operate in different markets, different regions, they perform different functions. I'm interested in dairy processing. There's some interesting, well-cited and published paper that shows that dairy processing cooperatives are embarrassingly inefficient relative to investor-owned dairy processing businesses. What the paper doesn't recognize is they don't operate in the same market. Like the dairy co-ops do something totally different. They don't do high-end processing for liquid fluid products. They do commodity butter and powder processing and storage, and it's a totally different function, and they didn't really account for that. So that kind of strategic difference is really, I think it would be one place to look at the membership issue specifically.
Brent, this is very good. My question, I guess it goes back in a way where you started with this difficulty of, people, scholars and policymakers trying to understand these these ideas and the terms that are using. And I guess my question is this: at least those, and maybe maybe this is part of the answer. There's a small group of us that, at least of ag economists and some economists, that clearly understand, if you like, that there's a return, call it profit, a net return from the co-op, and then there's a consumer surplus. And we've known this for decades.
Yeah.
Enke, in his 1945 paper, which is in the same time period, lays this out cold, and he's got it, and the rest of us have.
But capital's not in that story.
Well, but this is my question. What's going on that simple lesson, which is in the literature, it's been there, it's well understood.
Right.
Why didn't it get translated into other areas?
Yeah, no, it's a great question, and I glossed over this, but I did say answer is obvious, right? But subtle. I mean, it's a simple point. I haven't seen anybody make it, and I think the reason it hasn't been made, at least by economists, I think it's been made by lots of other professions. At least they've talked about it, and broader benefits and so on. But economists have not, because we are so reductionist. And I don't mean that in a bad way. I'm a big fan for reductionism and narrowing our focus to achieve scientific advances. But we've basically separated the world of corporate action into governance, finance, industrial organization, and HR. This is linking intimately industrial organization and finance, and so all those when you talk about corporate finance, there is no market. It's just revenue, and when you talk about industrialization, there's no finance. It's just there's no capital. It's just K, like big K, for fixed cost. So that, I think that people have just been operating in those realms, and there actually is a kind of an emerging literature on the interaction between capital markets and product markets. So how does intensity or differentiation and the structure of the downstream product market affect how you position yourself in terms of your capital structure? Do you want more or less debt? Do you want to show strength through your capital structure in the product market? That kind of thing. So I think this fits into that literature, and it, it's complicated interaction though, because both sets of models of those activities have lots of complications on their own, and so we have to bridge them. We have to be creative and simplify.
Is that all we have for questions? Well, now that you've answered the hard questions, please join me in thanking.
Thank you. Great. Yeah.